Welcome back to the channel where we dive deep into the fascinating world of how to borrow stocks and the mechanics behind potential short squeezes. Today, we're putting a spotlight on a fascinating ticker that's appeared on our radar, CIIT. We'll break down why this microcap stock is showing an incredibly high cost to borrow and what that could mean for its future, if anything at all. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's jump right into CIIT. This is a microcap company, and like many stocks in this category, it can exhibit unique behaviors. Looking at its recent price action, CIIT has seen 0.0% change today, 0.0% over the last 5 days, and 0.0% over the last 30 days. Similarly, its volume data shows 0 shares traded today, and a 30-day average volume of 0 shares, leading to a relative volume of 0x average. This lack of trading activity is a crucial detail we'll discuss shortly. The estimated float for CIIT stands at 7.3 million shares. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? In simple terms, it's the annualized fee that short sellers must pay to borrow shares of a stock before they can sell them on the open market. They do this hoping to buy those shares back later at a lower price, returning them to the lender and profiting from the difference. Why does CTB matter? It's a critical indicator of the supply and demand dynamics for shorting a stock. A high CTB suggests there's either massive demand from short sellers to bet against a company or, more often, a very limited supply of shares available to borrow. And yes, these fees can easily exceed 100% annually because it's an annualized rate. Even small daily fees can quickly compound when borrowable shares are scarce. Why this stock is hard to borrow right now. Now let's talk about why CIIT is currently on our hard to borrow screener. The standout number here is CIIT's annualized cost to borrow fee, an astonishing 899.2%. Let that sink in. An 899.2% annualized CTB is an extraordinarily high fee, indicating that lenders are demanding a premium to let short sellers borrow shares of CIIT. This typically signals an extreme shortage of shares available to borrow in the market. While we don't have the exact number of shares currently available to borrow for CIIT, a CTB this high strongly suggests is very low, if not zero. When you combine this with an estimated float of 7.3 million shares, which is relatively small, it further highlights the scarcity of shares. Our internal composite squeeze score for CIIT, which blends CTB, borrow supply, float, and momentum, sits at 43.5 out of 100. This is a moderate score, not screaming high, and it reflects the underlying lack of trading activity that might be offsetting the extreme CTB. Squeeze mechanics explained. For those new to the concept, a short squeeze happens when a heavily shorted stock suddenly experiences a sharp upward movement in price. This can be triggered by positive news, high buying volume, or just a shift in sentiment. When the price rises, short sellers, who were betting on the price to fall, face mounting losses. To stop the bleeding, they are forced to cover their short positions by buying back the shares they initially sold. This forced buying creates additional demand for the stock, pushing the price even higher, which in turn forces more short sellers to cover. It's a self-reinforcing upward spiral. High cost to borrow fees, like CIIT's 899.2%, amplify this pressure. Holding a short position becomes incredibly expensive, making short sellers even more vulnerable to an upward price movement and more likely to capitulate and cover their positions. Dilution risk check. When evaluating a potential squeeze candidate, dilution risk is a major factor. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can depress the stock price and provide an easy way for short sellers to cover their positions, effectively negating the potential for a short squeeze, even if the cost to borrow is sky high. For CIIT, we've checked for recent dilutive SEC filings such as SMINUS-1, SMINUS-3, or 424B forms in the last 90 days, and found none. We also found no recent reverse splits for CIIT in our look-back window. This is a positive for a potential squeeze thesis, as it means there aren't new shares flooding the market to provide an escape route for short sellers. However, it's critical to remember this is just one piece of the puzzle. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Here's a critical nuance for CIIT: a high cost to borrow does not guarantee a squeeze. It can also signal that short sellers have very strong conviction and are willing to pay a hefty price to maintain a bearish bet. In the case of CIIT, the most striking aspect is the complete lack of trading volume. With 0 shares traded today and over the last 30 days, there is no price discovery, no momentum, and quite frankly, no market action for a squeeze to even begin to materialize. A squeeze requires actual trading, buyers and sellers. For CIIT to even be considered a squeeze candidate in the future, you would need to see a dramatic shift, significant and sustained trading volume accompanied by upward price movement. The 899.2% CTB indicates extreme borrower scarcity, but without any trading, short sellers aren't being squeezed by market action, only by the cost of their borrow. You'd want to watch for any sudden influx of volume, a change in borrower availability, or a decrease in that exorbitant CTB, which would indicate less demand to short or more supply. So, CIIT presents a fascinating, albeit unusual, case study. We have an incredibly high cost to borrow at nearly 900% annualized, indicating extreme scarcity of shares for shorting, yet the stock is completely dormant with 0 trading volume. This creates a paradox: immense pressure from borrower fees, but no market activity to capitalize on that pressure. It highlights the complexity of hard-to-borrow situations and why high CTB alone isn't enough for a squeeze thesis. For CIIT, future trading activity would be the key. What are your thoughts on CIIT? Let us know in the comments below. If you found this explanation helpful, please hit that like button, subscribe for more deep dives into market mechanics, and share your questions with us. Thanks for watching, and we'll see you in the next video.